This weekend, while most people were casually scrolling through their phones and enjoying their time, something massive happened on the global stage. The United States launched what the Pentagon is now calling major combat operations against Iran. And when the markets opened on Monday morning, the reaction was instant. Oil prices jumped more than 7%. Gold surged to record territory above $5,300 an ounce, and Dow futures dropped over 500 points. But what caught my attention wasn't just the numbers, it was the reaction of retail investors. Because once again, many people did exactly what they always do during moments like this. They panicked, they sold their positions, and they made emotional decisions based on breaking headlines instead of long-term history. So today, I want to give you something the news headlines rarely provide: clarity. Over the weekend of February 28, 2026, the United States and Israel reportedly launched coordinated airstrikes against Iran in what analysts are calling Operation Epic Fury. Several strategic locations were targeted, including government facilities in Tehran, and within hours, one of the most important oil choke points on the planet, the Strait of Hormuz, effectively came to a halt. Now, why does this matter so much to investors? Because that narrow waterway carries more than 20% of the world's daily oil and liquefied natural gas supply every single day. When activity there stops, global energy markets immediately react. Shipping companies began diverting oil tankers, insurance companies suspended coverage for vessels traveling through the region, and Dubai's Jebel Ali, the Middle East's largest container port, temporarily paused operations. This isn't just another news headline, this is a major geopolitical event. But here's the question that really matters for investors. Is this the end of the world for long-term investors, or could this actually be the beginning of a massive opportunity? If you study market history, you'll notice something very interesting. During global crises, wars, attacks, or geopolitical shocks, the market initially reacts with fear, but that reaction rarely lasts forever. Think about past events: the Cuban Missile Crisis, the Gulf War, the attacks of September 11, the 2003 Iraq invasion. Every time something major happened, the markets initially dropped. But in many cases, they recovered faster than people expected, and investors who panicked and sold often regretted it later. Let's look at the scoreboard. Oil markets reacted first. U.S. crude WTI jumped about 7.4%, moving toward the mid-$70 range. Brent crude briefly surged toward $80 and beyond in early trading. Several banks have already warned that oil could rise much higher if supply disruptions continue. Some analysts are even discussing the possibility of $100 oil. Gold also surged dramatically. In a single session, gold jumped more than 3%, pushing it above $5,300 an ounce, a historic level. Meanwhile, stock futures fell. S&P 500 futures declined. Dow futures dropped more than 500 points. But here's the part most people missed. Not everything was falling. Energy companies moved higher. Defense companies also gained. Some of the biggest names in energy and defense saw strong upward moves as investors rotated capital into sectors that benefit during geopolitical tension. So the market wasn't simply crashing. The market was rotating, and understanding that difference is incredibly important. Retail investors often react emotionally. They watch headlines, they panic, they sell quickly. But institutional investors operate very differently. Large hedge funds, sovereign wealth funds, and professional traders analyze events strategically. When tensions rise, they often move capital into energy, gold, defense companies, U.S. Treasury bonds, safe haven currencies. They understand that fear in the market often creates opportunity. Imagine if the entire world depended on a single pipeline for energy. Now imagine that pipeline suddenly stops. That's essentially what the Strait of Hormuz represents. In 2025, more than 14 million barrels of oil per day passed through that narrow channel. Roughly one-third of the world's seaborne oil exports move through it. Countries like China, India, Japan, and South Korea rely heavily on that supply. So when activity there slows or stops, global markets react immediately. Right now, there are two possible paths forward. Scenario 1. If the Strait of Hormuz reopens quickly within days, oil prices could stabilize and markets may recover relatively fast. We've seen this type of short-term shock before. Scenario 2. If the disruption lasts weeks and months, oil prices could rise significantly. Higher energy prices could push inflation higher again, and that could delay interest rate cuts from central banks. This would create more volatility in the stock market. 5 important lessons for investors. Lesson 1. Wars create winners and losers. Certain sectors benefit during geopolitical tension. Energy, defense, gold, safe haven assets. Other sectors may struggle temporarily. Airlines, consumer spending companies, logistics businesses. Understanding sector rotation is critical. Lesson 2. Panic is not a strategy. Making permanent decisions during temporary fear rarely leads to good results. History repeatedly shows that patient investors tend to outperform emotional ones. Lesson 3. Inflation could be the wild card. If oil prices remain high for an extended period, inflation could accelerate again. That would affect interest rates in the broader economy. Lesson 4. Gold has become extremely important. Gold reaching record highs reflects global uncertainty. Many international investors are increasing exposure to gold as a long-term hedge. Lesson 5. Crisis creates opportunity. Every major crisis in history has created opportunities for long-term investors. Strong companies sometimes become temporarily undervalued because the market is afraid. Those moments often become the best entry points. The truth is, nobody knows exactly what will happen next. No one can perfectly predict geopolitical events, but history does teach us something important. The global economy has an incredible ability to adapt, recover, and continue growing. Markets may become volatile, prices may fluctuate, but long-term progress rarely stops. So your job as an investor right now is simple. Don't panic, don't make emotional decisions, and don't confuse loud headlines with permanent changes in the global economy. If this video helped you see the situation from a clearer perspective, make sure to subscribe for more content like this, and feel free to share this video with someone who might be feeling uncertain about the markets right now. I'll see you in the next video.